Digital banking architecture in 2026, components, principles, and what needs to change. Banks running on legacy core systems still spend 60 to 80% of their IT budgets just keeping those systems alive. That leaves limited room for what actually drives growth: faster product launches, better customer experience, and quicker compliance updates. Meanwhile, institutions built on cloud-native, API-first architecture can launch new products up to 50% faster and operate at 30 to 40% lower cost. The digital banking platform market reached $37.49 billion in 2025 and is growing at 19.8% annually. Competitive advantage now comes from the strength of the underlying architecture. This guide explains what modern digital banking architecture includes, which design principles matter most, and which shifts are defining the market in 2026. Core components of a digital banking system database management system, DBMS. The DBMS is the system of record for banking operations. It stores customer data, account details, and transaction history. Modern setups usually combine relational databases for transaction-heavy workloads with document databases, such as MongoDB, for flexible, high-volume processing. Transaction Processing System, TPS. The TPS handles deposits, withdrawals, transfers, and payments in real time. It must process every transaction accurately, maintain a complete audit trail, and meet record-keeping requirements. In 2026, overnight batch windows no longer match customer expectations. Customer Relationship Management, CRM. The CRM manages customer interactions across onboarding, service, and marketing. When integrated properly, it helps banks personalize communication and services at scale. Loan Management System, LMS. The LMS supports the full loan lifecycle, from application through repayment. In modern environments, it often connects to AI-based credit scoring tools that reduce decision times from days to minutes. Risk Management System. The risk management layer identifies and controls credit, market, operational, and compliance risks. Modern platforms use machine learning models trained on transaction data to detect fraud in real time and adjust risk exposure as conditions change. The 5 architecture layers and how they work together. A digital banking system is not a single platform. It is a set of connected layers that work together. Front-end interface, the customer-facing layer across web, mobile, and ATM channels. In 2026, this increasingly includes AI-powered conversational interfaces alongside traditional dashboards. Middleware layer connects the front-end to back-end systems, manages data exchange, routes requests, and handles external integrations through API gateways. Back-end systems, the core of banking operations, including the DBMS, TPS, CRM, LMS, and risk management systems. Performance here determines throughput, uptime, and data integrity. Integration framework connects the bank to payment networks, regulators, fintech providers, and open banking partners. In API-first architectures, new connections can be added in days rather than months. Security infrastructure, encryption, authentication, access controls, intrusion detection, and continuous monitoring built into every layer rather than added around the system later. 3 architecture shifts defining 2026-1. Composable banking treats each core function, such as KYC, ledger management, payment processing, and customer onboarding, as a standalone capability exposed through APIs. Banks can combine these capabilities across internal systems, fintech partners, and third-party providers without rebuilding the stack. Banking as a Service surpassed $1 trillion in total value in 2026. Composable architecture is what makes that model possible. Legacy monoliths cannot support the level of modular delivery this market requires, which is why core banking migration has become a top priority for many CIOs. 2. Agentic AI in banking is moving beyond isolated tools to autonomous agents that can reason, plan, and act across multiple workflows simultaneously. Banks adopting agentic AI report a projected 20% increase in operational efficiency, while broader AI adoption is associated with an average 15% gain in market share. In practice, agentic AI is already being applied to credit decisioning, fraud prevention, customer service, treasury management, and compliance. At scale, it depends on a composable architecture that allows agents to access data, trigger actions, and coordinate workflows without changing the core system. Banks still operating on monolithic cores will struggle to deploy this model effectively. 3. Quantum-safe cryptography. Threat actors are already using harvest now, decrypt later tactics, collecting encrypted data today, with the expectation that future quantum systems will be able to break current protections. Any bank planning a core migration should treat post-quantum cryptography as a design requirement for the target architecture now, not as a feature to add later. 10 design principles for digital banking architecture. 1. Cloud readiness. Modern core banking architecture should be cloud native by design, not simply hosted in the cloud. Lift and shift migrations often result in legacy systems running on cloud infrastructure, leading to higher costs, limited scalability, and slower delivery. Multi-cloud readiness should be part of the design from the start. 2. Open banking compliance. Open banking cannot be treated as a simple compliance checkbox. API vulnerability exploitation increased 181% in 2025. Regulated UK Open Banking (AP) is now report a 98.89% success rate, and global open banking API call volumes are projected to grow by more than 600% by 2029. Institutions that fail to build reliable API infrastructure are creating a scaling problem, not solving one. 3. API-first architecture. API-first architecture starts with contract-first design before implementation begins. It also requires discipline in versioning from day one. Banks that do not manage API versions carefully break partner integrations every time internal systems change. 4. Self-servicing. Real self-service means internal teams can adjust product parameters, fee structures, and business rules through admin tools without relying on engineering tickets. A modern front-end sitting atop a legacy back-end is not self-service. 5. Security has to be built into every layer. With 45% of consumers citing cybersecurity concerns as a barrier to wider digital banking use, banks need zero trust access, behavioral biometrics, MFA, across all access points, immutable audit trails, and quantum-safe encryption as part of the core design. 6. Flexibility and configurability. True configurability means the institution controls how products evolve. If changes can only be made through a vendor's proprietary tooling, on the vendor's timeline, and at the vendor's price, that is dependency, not flexibility. 7. Scalability. Scalability issues rarely appear in development. They surface during audits, market expansion, and sudden volume spikes, exactly when reliability matters most. Modern systems should be designed for horizontal scaling from the start, using load balancers, circuit breakers, and stateless services that can be replicated on demand. 8. Transparency and auditability. Regulators increasingly expect near real-time visibility. End-of-day batch snapshots loaded into data warehouses are already outdated by the time they are reviewed. Real-time event streams should support operational reporting, while structured batch pipelines continue to handle financial and regulatory reporting. 9. Data digitization. Digitization only creates value if the downstream architecture is ready to use the data. Projects that scan and structure documents without designing the destination data model end up with output that has nowhere useful to go. The destination should be defined before the pipeline is built. 10. Real-time processing. Real-time processing is not a front-end feature, it is a back-end requirement. Today, 61% of digital banking platforms support real-time fund transfers. That standard depends on back-end systems in which each transaction commits immediately and each balance is updated without delay. Why Inoxoft for digital banking architecture? Most vendors sell platforms. Inoxoft builds systems that are production-grade, regulation-aware, and integrated into the infrastructure that financial institutions already use. With more than 10 years in fintech and 230-plus completed projects, our team has delivered payment integrations, trading automation platforms, and banking CRM systems for organizations across the US and Europe. Why banks and fintech companies choose us deep fintech delivery experience? We have built payment service integrations, trading platforms, loan origination systems, and banking CRMs, and understand the compliance, data, and integration challenges unique to financial services. End-to-end architecture ownership. We handle system design, API integration, AI implementation, security compliance, and production support within one delivery model. Compliance by architecture. As an ISO 27001 certified company and a Google and Microsoft partner, we design regulatory requirements into the architecture from the first sprint. Flexible engagement models, dedicated team, project-based delivery, or staff augmentation, depending on what moves the program forward fastest. If your team is evaluating core banking architecture changes, the first step is a practical assessment of where modernization will create the most value. Conclusion: digital banking architecture is the foundation behind every future product, integration, and compliance requirement. The banks making the most progress are modernizing incrementally, one domain at a time, proving value at each stage before expanding further. The cost of delay is real. By 2028, outdated banking systems are projected to cost global banks more than $57 billion per year. The question is no longer whether to modernize, it is where to begin and how to structure the first phase so the rest of the organization can see the results clearly. For teams assessing the next step, the right starting point is a clear view of the workload, the constraints, and the business outcome the architecture needs to support.